Something unusual happened today. Out of the 11 S&P sectors that we have, 10 of them triggered on our volatility box models. Now that's something unusual. We don't see that happen. It's a very clear sign of increased volatility and what I think is very clear clues today of institutional money exchanging hands. And I'll show you what I mean in just a second. I think today there was a sector rotation that took place very clearly from technology, money moving out of tech into consumer staples. And I'll show you why I think that happened in just a second. Now let's start first with understanding what the overall setup is and what the broader markets are doing. And for that, I'll pull in a chart of the S&P 500 first. Now when I talk about this concept called the golden ratio, that's the 1618 extension, and that's the Fibonacci extension using the swing high to swing low from 2025. This is using the high to low and trying to use that to give us some sort of a roadmap. This golden ratio comes in at 69.53, and if you zoom in, take a look at what's happened with the S&P 500 at this level. We've been at this zone chopping around using this as a magnet now for really the first 30 days, 31 days of trading, with all of January trading near this level. So that's why I think this golden ratio is so important to take a look at, and we're looking for clues for which way price is going to unfold here. Are we going to see price move in the bullish direction or the bearish direction? And today, with money moving into a defensive sector, I'm leaning more towards price starting to take a little bit of a breather. But we need to see more clues of this. Otherwise, that's the overall idea, the decision matrix we need to make. So let's start with taking a look at a scorecard, which I think will give you better clues, and we'll go through sector by sector so your eyes can spot exactly what happened in terms of volatility. Now, the first sector that we're going to take a look at is the technology sector. And in fact, before we do that, I'm going to load in a chart of the S&P 500 so we can gain bearings of what happened in terms of volatility in the broader market. Today, the S&P 500 tagged our conservative volatility box models nearly perfectly and bounced from there. This was as close to a wick touch at the entry of our volatility box clouds near 684. Now, if you take a look at what happened at the time of this volatility inside of the broader sectors, you'll see that we had sell-offs at similar moments. You even had stocks like Google, for example, one more time making a return before you saw a pivot into the close. Now, along with Google and many of these larger name stocks, you also had the ETF. So what I mean by that, if you come into XLK, for example, you'll see XLK very clear volatility. In fact, the clouds here look almost compressed. The setup that took place inside of XLK was early on in the morning when price breached the outer edge of our conservative models, very quickly tried to make a move, hit T1, but couldn't really hit much further, and you saw just how quickly price reversed. So this is that sell side activity inside of XLK where I believe money transitioned out. Typically, you would see buyers here coming in and supporting price. And in fact, if I contrast this with a chart of, say, XLI, you'll see exactly that. Price sells off into our volatility box zones, and you have buyers very clearly defending, especially with something like these larger sector ETFs. You have a bunch of automated algorithms that kick into gear. In XLK today, we could not find buyers. In fact, the only place we found buyers was a little burst up. And beyond that, we had sell side activity breaking below even the conservative volatility box models, and that too decisively. So that's why I say XLK today, we broke outside of the models, but money was transitioning out of them given how we see the models looking. Now, if you flip this on the other side, XLP is where this money, in my opinion, entered. You take a look at what happened to the models here, similar idea. The models compress, but this time we're seeing buyers just rip higher, and there's no bears waiting to push price down lower. And if you think that, oh, maybe this is SPY sectors, we don't see that typically happening, you can actually contrast that with something like an XLE, where XLE, you can see price hits our models, and we see that sell side activity. You still have some automated algos in play, but those did not seem to kick into gear inside of XLP and XLK today. So that's why I think those two sectors stand out. Next up, you take a look at financials. Financials today, and every other sector, in fact, outside of the defensive sectors, triggered mostly bearish setups. And what I mean by that is we had sell side activity giving us an opportunity to buy the dip. Now, financials did not breach the conservative models, we breached just the aggressive models. So if you were to compare and contrast the volatility of XLF versus S&P 500, SPY was more volatile today given that we breached our conservative volatility box models, whereas XLF breached just the aggressive before we saw the reversal, all taking place around the same time, which was 11 a.m. Pacific is where we saw the rally kick into gear. Now, in some of these other markets, you'll see early morning strength, and we'll take a look at that in just a second. So XLF, you get an example to see how buyers kicked into gear, very similar to the S&P 500. Next up, we have XLC. If we come in, load a chart of XLC here, XLC, you should notice, breaches the conservative models, giving you an idea that the volatility here is in line, very similar to what we see with the S&P 500. So XLC breaking outside of the conservative models, we see the buying strength only in the tail end, but the strength leaves a lot to be desired, especially when you contrast that with some of the other sectors in which we saw very clear strength. So XLU, for example, is one of those. If we load in XLU, we've been looking at XLU for quite some time. Early morning strength, hit our models, and see a little bit of that pause, a little bit of sell side activity, the automated algos kicking into gear. We did not see that again in XLP today. So XLU, really nice short side setup, but we're looking more for long side entries there. Now XLI is the one sector which hit not just a long side setup, but we rallied so much that we triggered the short side setup as well. And I don't think the short was really an interesting setup. More so, it's just a clue of how much strength we saw inside of XLI today. So XLI, very clear, buyers hanging around waiting to buy the aggressive volatility box models here. So I really liked XLI in terms of the strength we saw. You compare that with XLB and you should notice something similar, just a little bit less strength, but more than what we saw in something like XLC. Next up, we have XLY, and after XLY, we'll look at XLE. So inside of XLY here, you have, similar to what we saw inside of XLB and XLI, a little bit of a nice rally into the close. In XLE, you had bullish strength early on in the morning, that one little bit of pause before we ripped higher. Now, beyond XLE, there's two more sectors that we have left. The first is XLRE. XLRE is the one sector which did not breach either side's volatility box models. We just chopped in between, so the one sector with the least volatility. And finally, we have the healthcare sector, which just like the other sectors, breaches the aggressive models. We see the buyers, except unlike the other sectors, we see sell-side activity into the close, whereas inside of the S&P 500, we saw a rally. Inside of XLI, XLY, XLB, we saw strength into the close. In XLV, we don't see that same strength. So now if we were to zoom out and take a look at this entire scorecard, there's three sectors which scream bullish. Those were utilities, energy today, and then consumer staples. And everything else across the board triggered more with sell side activity for a buy the dip setup. And there we saw that one in particular, XLI, really stood out. Now the question is, how do we use all of this information? Well, first off, we can make the observation, which we've pointed out, which is money is leaving the tech sector and we have money transitioning into consumer staples, which is a defensive sector. We saw this taking place with both charts here. XLP, money entering into the markets. XLK, money exiting the markets very clearly. What does this tell us? Well, very clear risk-off signal. We have money leaving a more aggressive sector, one that's typically representative of growth, and going into XLP, a sector that's typically representative of a little bit more of a defensive sector. Now, taking all of this volatility and using that into something we can trade, SPY, very clear tradable volatility today, breaches the conservative daily volatility box models, and it provides you access to volatility across all 11 of these sectors instead of needing to pick and choose each of these sectors like we saw today. And that's what makes today a little bit unique. So if we were to summarize 5 key takeaways from today's video, 1, volatility is accelerating. We saw today volatility box models were triggered in 10 out of the 11 sectors, and they actually worked, which tells you that these were the automated buy and sell algos working at this chop level of the golden ratio. There were two sectors in which that didn't really work, and we've talked about them at great lengths, XLK and XLP. That confirmed our risk off sentiment, and we had ways to trade this overall trade sector rotation with the S&P directly instead of needing to pick and choose sectors, or you could pick and choose sectors with all 11 sectors really in some way, shape, or form outside of XLRE offering you an entry setup. The golden ratio seems to, as we continue to hug this key level here, that 69.53 level, it seems to be a magnet. Currently, we're below that level where we're looking for moves into that level. And today we had our next signal with that 5-minute cumulative tick triggering near that 68.80 mark for a move back up into 69.53. So that's the overall idea. Until we break this golden ratio, I'm looking at this as my roadmap, looking at trading both the SPY volatility along with the individual sector volatility. We don't typically get days like today, but when you do, you'll notice that volatility is spread between all sectors, and you can take and pick where you want to trade based off of your trading style. Hope you found this video helpful. Take care, everyone. Good luck trading, and I'll see you in our next update.